Is this a market right now that is still very predominantly driven by Fed speak and interest rate direction and severity?
Yes, everything the Fed says, people watch, and the market takes a little zip up or down because of that. It's remarkable, though, how far Treasury yields have come down, even in the face of conflicting information from the Fed about are they aggressive, are they not. But Treasuries, to me, are telegraphing that the Fed is going to slow down the rate of increase.
Now, Tiffany, with that in mind, as you lay out an investment strategy for your clients, is there anything that concerns you about that interest rate macroeconomic narrative? Is there anything out there that we don't already know, or is this just about kind of adjusting and fine-tuning positions for your clients, given that overall story?
Yeah, I mean, listen, I don't think there's anything out there that we don't already know. I think the big news this week is clearly going to be the November jobs report. And so the bottom line is bad news for the job market is good news for the Fed, right? For the Fed to start reducing rate hikes. And so, they'll need to see a movement in a certain direction to reduce the rate hikes. And so the key metrics I'll be watching are jobs added, unemployment rate, and the wage growth. And so, we basically need the amount of jobs to go down, the unemployment rate to go up, and wage growth to go down for the Fed to really make a move in this last meeting.
Now, Margie, the inflation story is top of mind for so many out there right now for good reason, because interest rates have been controlling the direction of valuations. Valuations have been coming down because interest rates are higher. There is now an alternative out there to put your money besides stocks. If that's the case, how long do investors have to stay more defensively oriented? When can they feel like they can go back into some of those growthier stocks that have been leadership for the better part of the last decade or two?
I think what we really need to see is what is happening with the economy. The Fed has tightened very aggressively, a record increase as from the beginning of the year till now, and we really don't know if that's going to affect the economy. Many analysts are thinking we may see a true recession in 23 because of this aggressive tightening. So I think it's a little early to say, okay, it's time to jump in because price earnings ratios are down, because if we have a recession, we may well see earnings go down too. And that would say to me that growth stocks may not be relevant to propel themselves up. So we're sort of watchful waiting here to see what happens in the real economy.
So Margie, if I could follow up on that, if that's the case and that is your thinking and current construct for evaluating the market, are there still stocks out there that you think are attractive or that you would put on your shopping list?
Yes, I think so, because the stocks are reasonably priced and you never really know when the bottom is to jump in. So we like the technology sector, particularly semiconductor sectors, which have gotten hit very, very hard because of the oversupply and some weakening demand in some areas like PCs. But we think looking beyond, say, mid-year, we may see the inventories work through and those companies, the leaders, begin to have a growth path upward. And also, we like the defense companies. They are defensive, as the name implies. A lot of their revenues are coming from governments, so they aren't going to be cut. And they're high-quality companies with reasonable dividends. So we think that's some pretty good places to put some money right now.
All right, so that's on her list for Margie. Tiffany, I wonder, this is also a retail-centric time of the year. It's a seasonably strong time for the market. The retail narrative is so much a part of the overall market, especially in the last couple of months of the year. I wonder, in your mind, is retail a part of your game plan in the coming months?
It is, Dom. And so right now, I like the specialty retailers. They've actually fared well, especially for Black Friday. Two names that I like right now and actually have liked for quite some time is Ulta Beauty. They actually report earnings this Thursday. They fared well despite market declines. It's up almost about 11% year to date. And also Victoria's Secret, they also report earnings actually on Wednesday. They're up about 29% in the past 3 months, still down year to date, but they've got decent cash flow, relatively fair valuations. They've got 20% of the U.S. lingerie market and 30% of the U.S. mass fragrance market. So we think that they're really positioned to continue to do well.
And Margie, one last word from each of you both here. I wonder what the biggest fear that you have right now is. Is the market bottom in, or is there still something else that could take us down towards those lows or beyond?
Well, I think the biggest fear is really the Fed. The Fed historically has over-tightened, caused a recession. It almost looks like they're on that track now because of raising short-term rates by over 350 basis points. So that's really my main concern. Will they bring on a recession next year and drive up the unemployment rate, which of course is very bad for those people who lose their jobs. So we're on the sidelines, but we're a little concerned about the Fed activity as the main place of risk.
And Tiffany McGhee, last word to you. Is the bottom in, or do you think we go lower from here?
I hope so, but I think that we're going to be in this kind of like weird place, at least for the next couple of months. And so, you asked about fear earlier. I don't like the word fear. Scared money doesn't make money. So as long as you kind of stick to the plan and figure out, kind of plan out your tactical moves of your portfolio from now to the end of the year and all into Q1, I think you'll be good.